Coming up on this episode.
If you're starting, I say start with the most basic products. Don't go into cryptos and things that are complex that can throw you off. Start with the basics, then progressively grow. Build your resilience. The secret to investing in wealth management is consistency and time, because time is your biggest resource.
Hi and welcome to the ICIFA Investment Show. This is the Emerging Trends edition. And of course, we keep the conversation going. The question on the table today is, who is the investor of tomorrow? And joining us in this conversation is an amazing person, FA Elizabeth Irungu, council member right here at ICIFA. Elizabeth, it's good to see you.
Thank you very much, and nice to see you.
Excellent. Before we dive into a topic, let's help our viewers get to know who you are and probably where you're practicing your FA skills.
Great. So the first thing is that I'm an FA.
Yeah.
I'm a financial analyst under ICIFA, so I'm registered. And I'm the CEO of Absa Asset Management Limited currently.
Yeah.
And what else? We offer investment services to the wider nation through Absa Bank PLC.
Yeah.
So that's me. I'm a CFA charter holder also.
Okay.
And I've been in the investment industry for more than 20 years.
Quite
so
some
I know
time.
a little.
Absolutely.
Yes.
You're right. And we have crossed paths sometimes just discussing this investment landscape. Our subject today is about the investor of tomorrow. And looking at our theme, Emerging Trends edition, there must be so many things that are coming up, so many things that are changing in the investment landscape. And we want to help the viewers to understand a few things. I know we may not be able to cover everything now, but a few things could at least enlighten them. My first question to you is about when you hear the investor of tomorrow, first of all, what comes to mind? Who is this investor of tomorrow?
That's a very interesting one because tomorrow never comes. So let's start at that point where we are saying the investor of today. Who is the investor for tomorrow?
Yeah.
So if you cast your eyes back, investment has been largely, a brick and mortar kind of scenario where majority of people who invested, they invested in land, properties, and things like that, which are excellent investments. We
can call them traditional investors.
Traditional investments, but really, really great investments. Honestly, they are capital intensive, but that is where most people started. To the other spectrum, they really did not move to the spectrum of capital markets or products that are fund management driven. So in the current environment we are in, we are seeing a shift from the traditional asset classes, real asset classes, farms, land and things like that, and a move towards the capital markets, and most importantly, professionally run kind of funds. So we find people are, the future investor is looking at professionally run investment products. And of course, also looking beyond the boundaries of Kenya. So because the conference has been Kenya, now we are finding the investor wants to go beyond the boundaries of Kenya. And they don't go to Uganda. They want to go far. They're going offshore. They're going in developed markets. So very interesting dynamics. The other dynamic for the investor is that we are seeing now more younger generation people coming into the space. So younger people investing, and they want to invest their way. They want to invest how they know best. So give them the ability to do it, and they do it themselves. Previously, it was very much following the herd. So all these people are buying because we are in one chama, we all go together. Today, we are seeing individuals making decisions as themselves. So even in the future, I expect that will continue. We're still not there. If we use the statistics of Kenyans with at least a money market fund, which is the most basic investment product you can buy, we can say we have about 2.5 million people who are invested. That's about 8% of the adult population.
Absolutely.
Is that good or bad? My assessment says it is a fair place because we've come from levels of about 1%. So penetration is fairly good. If you compare with South Africa, they are at 7%. But if we compare with the developed markets, which of course is where we aspire to go to, developed markets are at 54%. So we still have a long journey
a long way,
before many of us can take up investments and they make it a lifestyle, not just a dream. It has to become a lifestyle.
That's a great context. And I love the fact that you brought in an element of youth.
Yes.
Which is now that you're calling them the today investor.
Yes.
We're still also calling them tomorrow investor. Yes. And of course, women as well, because traditionally, as if you look at the statistics, there has been a lot of, especially looking at the traditional ways of investments that you've mentioned now, there was a lot of men and a patriarchal way of looking at things. But now we're talking about bringing in inclusivity.
Yes.
What are your observations so far, and where is the place of this in the future of investments?
That's a good observation, honestly.
Yeah.
But that divergence came because of the real asset element, owning homes or owning land and things like real assets. Women don't have an edge on that.
Yeah.
However, now when you come to the capital markets, women are actually making are very active in it because it doesn't require titles and approvals which are lengthy and patriarchal.
Yeah.
So it's very democratic when you come to the capital market space. Capital markets allows anybody, so it's very inclusive.
Yeah.
So in the current environment, when I assess the number of women or the split between women and men investors in our portfolios, to my assessment, I find women are actually higher. The numbers are higher.
Okay.
Now, what is interesting to note is that more women are investing. However, when we go to value, now let's say I have $1 billion invested by this group of people, 60% can be of the gender, can be women. However, when I go to value, you find 80% of the 1 billion, it's owned by men. So the fewer men who are there, they have it all. So the value element is where now we need to work with. I think because also in terms of earning, women earn less than men, even when they have equal jobs. So we see it also coming out on the side of portfolios where we are seeing women are investing, more women are investing, but the value of investments they have is lower. So it is a good thing that more women are in, but we still have work in terms of ensuring that they are also getting higher value. They're investing bigger portfolios, not very tiny portfolios. So that's the divergence that we have seen in the investment landscape.
Wow, I love that. And I love the color that you brought into that. Let's talk about what we're seeing in the trends, especially in technology, because you sit in a seat where you want to have as much access and as much of the populace really investing. And definitely technology is something you cannot wish away now.
Absolutely.
So where is that place? And what are you observing, especially when it comes to digital platforms to improve access to investments?
Great. Now, digital platform, and let's give it to telcos, they have come and liberalized the markets. They've liberalized the capital markets and the investment markets so that more people have the ability to access investments right on their phones, whether it's a feature phone or actually a high-end phone like yours. Everybody can be able to now access investments. So one thing that we can attribute to technology is that it's taken the investment conversation to every household. So as many people have access to actually save or to invest, to not only save, but save and invest. Now, the downside of technology is investment is complex. It's not as simple. So while we make it easy to tap and go, the mechanics behind the investments is what becomes the real challenge, because in terms of investment knowledge, most people still do not have the investment knowledge. So they have the investment tools which are very easy to click and do and send money at the end of the day, but they do not have the investment knowledge to select the right product that fits their profile. Now, what you will appreciate is that as individuals, we are very unique, just like the way we were created by God. You're unique, I'm unique, everybody is unique. So even in terms of investing, our uniqueness needs to be reflected. So perhaps, and I'll give you an example. Shega, you can be an investor who is most suitable to buy equities,
Yeah.
because maybe you're at a stage in your life where you want capital growth. Well, myself, I could be in a stage, maybe I'm aged, I'm at a stage where I need to preserve. And so my investment style should be, I preserve as much as possible. I need liquidity. So the two of us cannot invest in the same way.
Yeah.
But when you go to the platforms, if you do not have that knowledge of how to profile yourself, you will end up picking the product that looks most rewarding.
Yeah.
So you find, maybe we tell you, if you come to this fund, you earn 30%. But when you come to this other one, it's 9%. Who wants 9? I only want 30.
I want the 30, yes.
Right?
Yeah.
30 looks amazing, but
good.
doesn't tell you that is good for somebody who has the ability to wait out or to go through cycles. Well, 9 is for that somebody who wants stability and peace of mind, because it's maybe a money market fund. So those are the dynamics that we need now to deal with. Investor education, we need it. And I like that we are speaking about this, because this deepens the investor knowledge and allows people to be more aware how they're selecting the investment products, even if they're just available at the tap of a finger. So very interesting. And there's still more work to be done, even as we use technology. So we need to use now technology to teach, and not teach what product, it's to teach people and to give people the awareness of how to evaluate an investment product.
Yeah.
Yes.
And I love that you bring that in, Elizabeth. One of the things that I see, yes, technology has its pros, as you've said, but there's some cons. One of it is, let's give an example. On my mobile right now, I can invest on a money market fund, for example. But because it's a click, I'm also being told I can also withdraw that money anyhow.
Anytime.
And so my worry is for you, the person who I have given the money to invest on. And then I have here on this other end, customers who probably their patience levels are low. And we just expect, I want my money with the interest and the likes. What is the net effect of guys who just check in, check out? What have you observed? Because you are in the field.
So I'll give you my honest answer is, we've encountered some people who have said, I love this technology. It allows us to come in and put our money, but
easy.
I'm on a weekend, I'm with the boys or I'm with the girls, and we are running out of cash, and I can quickly go to my portfolio and remove my money. So the temptation becomes very high because of that liquidity element. Like I said, the challenge is maybe the knowledge of why are we even investing. When you don't have a goal, then you fall into that trap. I try to tell my investors, always have a goal while you're investing. When you move to investment platforms, you must remember that you are an investor, not a consumer. You're trying to postpone today's consumption to the future. So you cannot use your portfolio for today's consumption, because exactly the reason why you went to an investment is so that you postpone instant gratification for future benefits. So you focus and you keep to that goal. One way to align and steady yourself as an investor is to always have a tag of why am I saving. For example, this is money for school fees. This is money for our holiday. It will mean anytime you're tempted to go there and click and get that money back, it rings and you remember, that means I will not go for a holiday in December. That means my child will not go to Harvard because I have eaten the money. That means we don't have an emergency fund, and emergencies do happen. So when you have that awareness, then self-control starts checking into you. So I would advise every investor to have a goal that they really, really have to keep towards, so that they can keep away from these digital tools that are giving them access. But not to say that when you have an emergency, you can't get the money. Use it for the right reasons. Use your portfolio for the right reasons, and really respect it. Money likes being respected.
Okay.
Yeah.
I love that, Elizabeth.
Yeah.
I know that's an interesting conversation. I have an idea. Tell me whether I'm right or wrong. Maybe at the stage of withdrawal, yes, this is an emergency kind of fund and the likes. I think probably we should put safeguards where it's a T+1 or something of that sort, that your settlement will come probably the day after to avoid those boys things, to help people be patient. But anyway, speaking of the young people, there's a lot that I'm more concerned about. Where is our money being invested? I'm talking about the advent of ESG. There's a lot of questions of really ensuring that even the people who are giving money are ethically doing these things. So I wanted to ask you about the ESG conversations. What role should ESG principles play in shaping the portfolios of future investors, in your opinion?
Very good. Now, ESG is a big conversation worldwide. Now, portfolios are built by managers. So one of the ways to ensure that our portfolios are ESG compliant is managers to start abiding to some rules. There are principles, for example, by the UN. So responsible investing principles by UN. Now, if most of us can subscribe to those principles, then it means that our portfolios, the underlying portfolios that people are buying, then they will be considering matters ESG. Right now, it's voluntary. How Absa does it is very different from how another manager will do it. But once we get principles or we subscribe to principles that are governed by a body, then it means that then accountability becomes much easier. And then we can promote ESG investing. Now, the other thing is also awareness to the investing population. They even know that there is ESG investment principles? So we also need to create that awareness to the investing population so that even when they are vetting the type of manager, the type of fund they are going into, they can check for the ESG, compliance levels. So disclosures need to be there. Frameworks that are governing the fund managers need to be there. And of course, awareness to the people. So that's how we can approach it. But I like the younger generation. They're very interested to know what firms are doing towards ESG and their commitment to for example, the SDG principles by UN.
Okay.
Yes.
Let's talk about market volatility and, of course, economic shocks that have always come in and going sometimes, and sometimes tend to shake our investments.
Yes.
I wanted to ask you, how can new investors build resilience amidst all this?
Okay. And you're right. The volatilities or the shocks in the market have become shorter. When you were in school, when we did economics, I did economics. One of the things our professors said is that economic cycles take 5 years. You go through a boom, then you start coming down, you're in a trough, then you back up 5 years. And that is how we would actually model. Like 5 years, expect at least one shock. Now, shock on us. Now, these cycles have become shorter and really, really bad. Think about it. I'll give an example. COVID. COVID-19 came and we thought, wow, COVID-19 has come, and that was one of the troughs.
Worst,
So before we got out of COVID-19, we were in trade wars.
I know.
The next thing, before you could get out of it, you were in Ukraine war. Before you get out, Israel. So you find the shocks are many, and the impact is really big. And even if the shock doesn't start in your country, Kenya, it can start far away, but it will hit you as though you were in the epicenter of it. So now, how do you build portfolios in such a scenario where things are moving? It's no longer around election cycles of Kenya. It's around everything in and outside Kenya. So to build portfolios that are resilient, one principle that an investor must follow is diversification. You cannot be in one asset class or one geography, especially for the high net worth. I say that because if you're starting, you will find that most of your investments will be in one geography, Kenya. But the moment you cross a certain threshold and you're a high net worth individual, $1 million, I would say time to think diversification, not only on asset classes, but also geographies, because different geographies will handle these volatilities differently. So diversification has to take care of your geography. So when you're really a high net worth, and has to take care of your asset classes. I like the asset classes because we have them here in Kenya. Asset classes, you can't stay in money market fund alone. You need your money markets, you need your equities, you need your bonds, you need your private equity, you need your property. So everything has its place. And then look at your portfolio holistically. Don't look at it in tunnels. If you look at it in tunnels, you end up having challenges because it's imbalanced. So that's how you find currently our older generation, they are asset rich, cash poor. Because their portfolios were always kamogoda. That's it. Yes, like that. So we've got to run away from that.
You're right.
Yes.
Wow. Your final advice to someone who's looking forward to start or grow their, investment journey, start their journey or probably grow their investments. What would you tell them?
Great. Now, the biggest thing is to start. You've got to start. And guys, you have to start wherever you are. Not because you have made it. It's because you have a goal and you have a future. All of us have a future. By just being alive, you have a future. So you've got to start with whatever you have. And if you're starting, I say start with the most basic products. Don't go into cryptos and things that are complex that can throw you off. Start with the basics, then progressively grow. Build your resilience. So you start with the basic. I say the most basic product is a money market fund. Start there. Start there. Build the discipline of every day or every month you're putting aside something. You're postponing instant gratification for future, wealth. So put aside money. The secret to investing in wealth management is consistency and time, because time is your biggest resource. So if you're a young person, you think you don't have money to start, but you have the biggest advantage on time. You've got long life ahead of you because I know God will keep you. You have got long life. Unlike an older person who may have more money today, but the time ahead of them is a little shorter, so they may not be able to accomplish as much as possible. So my advice is start wherever you are with whatever you have and be consistent. And the other thing is you've got to budget at all times. If you're not budgeted, that's how you end up tapping onto that app, because you need to pull money. Budget and stick to your budget. Keep adjusting your budget because your life is changing and it's dynamic. But always remember 20%, 50, 30, 20 rule. 50% for your major items or core things that you must do. 30% for repayment of other or your luxury element, and 20% must go towards your savings.
Wow. And with that, we're safe.
You should be safe. Then come to Absa.
I like that ending.
Any branch, anywhere.
Yeah, absolutely. Absolutely.
Yes.
Thank you so much, Elizabeth, for your time.
Thank you.
Excellent.
Great.
There you have it. That's the conversation with FA Elizabeth Irungu. Lots of lessons to take home. See you next time on the next episode. But please ensure that you subscribe and share this as well with your loved ones. Bye-bye.